That Hormuz. Well, let's get in, our guest then, Alpha Manager of the Day, Rupen Rajguru of Julius Baer, who joins us. Hi, Rupen. Good afternoon. Good to see you in. It's been a while since we spoke, I think, but good to connect. What are you making of the current market setup? We have the last 1 year has been an absolute flat year, but individual stocks have done a thing of their own. The problem is there are more number of stocks that are lower than higher. How are you feeling about the market? Do you share that optimism that Q2 will be, the worst in terms of earnings? And the second half of the year, we see earnings recovery. And in that sense, you rather buy than sit on the sidelines.
Sure. Nigel, I would say that the Indian markets currently is like a spring, a compressed spring, wherein it has a lot of potential energy, but there is momentum is lacking for conversion of potential energy into kinetic energy. And why do I say so? Why does it have potential energy? Because if you look through from a relative basis, the Indian market has been a big underperformer. YTD, market in dollar term is 0, wherein the emerging market, which includes India, that index is up 30%. Why? Because China is up 40%. Korea is up 60%. Japan is up 20%. And even Brazil, which again, we are both on the same seat as far as the US tariff is concerned, it's also up almost 35 to 40%. So we have been a big relative underperformer. And what's the reason for this underperformance? Is one of the key reasons is earnings, as you also rightly alluded. Now, here, the catalyst for the earnings growth coming both from the government as well as RBI. Both are in place. So be it fiscal measures, that is by way of tax cuts, both direct as well as indirect, which according to us will add more than 2.25 odd lakhs crores of money in the hands of people. And the monetary stimulus, that is by way of rate cuts, which in a way also helps. So net, we are positioned for an earnings uptick. So that momentum which is lacking, which as you rightly said, will come from third quarter onwards. And the earnings growth, which has been in single digits for now 8 quarters, which probably will be similar in this quarter as well, but it will move into healthy double digit from Q3 onwards, and that will add to the momentum. So to answer your question, yes, we have been a big relative underperformer, and all the necessary impetus is in place, and probably from December quarter onwards, we should start seeing a double-digit earnings growth, which will lead the market higher.
Okay, all right. This double-digit earning growth, Rupen, hi. Thanks very much for joining in. This is Ekta. Just wanted to understand, what are you penciling in for the consumption plays, considering that we would probably see the GST benefits seep through by then as well?
Hi, afternoon, Ekta. Yes, if you ask me, one big macro theme from an India perspective, which will do well, at least initially, tactically, we have to see structurally how it pans out. But tactically, for a few quarters, would definitely be consumption. And as I said, that almost 2.5 odd lakhs crores of money will come by way of direct as well as indirect. And also, you add to it, banning the RMG, which is the real money games, which will also add further 20,000-30,000 crores in the hands of people, which was otherwise going that on that side. So the question is that how will that money be utilized? While the leverage in the system from a personal loan perspective is there, so some part of that will be used to repay the leverage. The other part definitely would be saved, and money will come into savings through the investments and other revenues, and also a chunk of that money we believe will get into consumption. So that clearly has a big multiplier effect. So and if you see, consumer as a sector had a dream run between say 2010 and 19, that decade. All of them got re-rated in a significant way, and for last 6 years it has been a big underperformer. It has seen de-rating. While on absolute basis, staples still are not cheap, but some of the consumer discretionary and durables clearly we believe will be winners in this. And to answer your question on the overall earnings growth, consumer will play a big role next year, and also corollary to that, some of the banking channel which are into retail consumption, which majority of banks are, and NBFCs also will attribute to the overall growth, and hence the overall profitability of that segment also will be pretty strong in FY27.
So if you had to bet on the sectors that will lead this double-digit growth, it's financials, some of the consumer discretionary names. What else?
So hi, Mangalam. On the growth side next year, on the consumption also, telecom is one sector where we believe the earnings growth will be pretty strong. Probably upwards of about 20-25% on a PAT level, while there is one big company which is listed out there. So as I think you rightly said, the financials, probably the earnings growth will be at anywhere between 18 to 22% growth. I am talking about FY27 vis-a-vis FY26. The challenge, if at all, from an overall earnings perspective, will come through whether we have to see how the IT earnings pan out, and we believe that IT earnings also are close to bottoming, and in FY27, over the base of FY26, we'll see a decent growth. We have to also take into consideration the INR depreciation. So net, I think combination of financials, consumptions, also telecom, and to some extent, the largest market cap company also, which has a play of consumption embedded in that also will lead the earnings growth.
What's your sense in terms of what IT could probably do in the next 3 quarters? We are kicking off earnings soon enough. What's your sense?
Yeah, Ekta, IT has been in the news globally for all reasons related to AI, and in India for reasons not related to AI, because the Indian IT services, and in fact, historically, till this year, beginning of this year, there was a strong correlation between IT sector and NASDAQ. And this year it has been broken purely because of this mega theme of AI, which the entire, has taken the world by storm. And an Indian IT services company are missing in that space. So that relationship has been broken, and we, in fact, not only us, but globally, Accenture, Genpact, all have been big underperformer this year, down anywhere between 20 to 30%. So have been the Indian IT services. So at this juncture, while, as I said, earnings growth still, will be a very anemic, but we have to also see from a stock market perspective. As we speak, the large cap IT companies are at, say, if I were to take FY27 earnings, are on an average at around 20 and some at even 19 odd P multiple. And in fact, in your channel only, I had said once that probably when there is no growth in the sector, which is what we are seeing right now, that the range for IT becomes 18 and 22. So probably becomes a buy when it comes to 18. So we are slowly getting into that level, and probably at 22, 23, it becomes a sell because there is no earnings growth. And why is it an earnings? Why is it a buy at that level? Because at that 18, 19 P level, the dividend yield or the FCF yields becomes upwards of 4.5%, which becomes very attractive. I think the known unknown is AI, and we believe that the Indian IT companies, like the way globally Accenture has pivoted, I think everybody wants to get themselves ready to also adapt AI for improving the overall efficiencies, which they can eventually pass on to the clients as well. So there will always be a phase in which there will be a consolidation and then the growth. And in fact, mind you, we believe that 2 years down the line, the kind of use case which AI enterprise will have, I think Indian IT services will play a big role out there. So net, to answer your question, it looks pretty attractive to, one can start nibbling into large cap IT names at current.
All right, start nibbling into large cap IT names. That's what the street has been doing as well over the last few trading sessions. It's been trying to find its feet. Rupen, always a pleasure speaking with you. Thank you so much for joining in and giving us your sectoral calls, your view on the market, where you believe that it is a compressed spring, may perhaps, jump from here on. But it's